The next big recession. What history says about 2025's economy. Economic recessions are a natural part of the financial cycle. Periods of booming growth eventually give way to contraction and decline. As we move through 2025, economists, investors, and the average person alike are beginning to ask a crucial question. Are we on the brink of the next big recession? While no one can predict the future with absolute certainty, history provides valuable clues that can help us understand the warning signs and possibilities ahead. Economic echoes from the past. To get a better sense of what might be coming, it's helpful to look backward. Historically, major recessions have shared certain patterns: overheated markets, rising interest rates, political instability, and external shocks. The Great Depression of the 1930s followed a speculative stock market bubble. The recession of the early 1980s was triggered by soaring interest rates to combat inflation. The 2008 global financial crisis was rooted in unsustainable real estate lending and the collapse of Lehman Brothers. In each case, early warning signs were visible, but not always heeded. Fast forward to 2025, and some of those same signals are flashing red again. Inflation, while not at the crisis levels of 2022 to 2023, still hovers above ideal targets. Global debt has reached historic highs, consumer spending is slowing, and interest rates remain elevated after years of aggressive hikes by central banks. Inflation and interest rates, a double-edged sword. One of the most significant contributors to recessions is inflation, particularly when it spirals out of control. In 2022, inflation surged globally due to pandemic-driven supply chain disruptions, government stimulus programs, and soaring energy prices. Central banks, especially the U.S. Federal Reserve, responded by sharply raising interest rates. By 2024 and into 2025, inflation has cooled somewhat, but not to pre-pandemic levels. Interest rates, however, remain high, making borrowing more expensive for businesses and consumers alike. This dynamic often leads to decreased consumer demand, reduced corporate investment, and slower economic growth, three ingredients that often signal the start of a recession. Historically, the Fed's efforts to soft-land the economy, curbing inflation without triggering a downturn, have had mixed success. For example, during the 1980s, rate hikes tamed inflation but caused a recession. In contrast, the mid-1990s saw a more successful attempt at balancing inflation and growth. The outcome in 2025 remains uncertain, but history reminds us that overly aggressive monetary tightening can easily push the economy over the edge. The Tech Bubble 2.0. Another historical comparison being made in 2025 is to the dot-com crash of 2000. In recent years, there has been a frenzy around artificial intelligence, blockchain, and electric vehicle technologies. Valuations for tech startups have skyrocketed, even as many of these firms remain unprofitable. If history repeats itself, the bubble could burst just like it did at the turn of the millennium. Overinvestment in unproven technologies, excessive speculation in tech stocks, and unrealistic expectations about short-term profitability could lead to a market correction. If that correction is severe enough, it could drag down consumer wealth and investor confidence, two critical pillars of economic stability. Global tensions and economic fallout. History also teaches us that recessions are often sparked or worsened by geopolitical tensions. In 1973, for example, the oil embargo led to stagflation and a global economic downturn. Today, global unrest, including the ongoing war in Ukraine, tensions between China and Taiwan, and the conflict in the Middle East, threatens to destabilize key supply chains and energy markets. Trade restrictions, rising energy prices, and investor uncertainty can all result from geopolitical conflicts, and these forces often push fragile economies into recession. In 2025, the global political landscape is far from calm, and the risks of economic fallout are very real. Labor market resilience, or warning sign? In past recessions, the labor market has often been a lagging indicator. Employment numbers tend to remain strong even as other areas of the economy begin to contract. In 2025, job numbers have remained relatively healthy, but cracks are beginning to show. Some industries, especially tech and finance, are seeing layoffs and hiring freezes. Meanwhile, wage growth is slowing, and labor force participation remains below pre-pandemic levels. If the job market starts to soften significantly, that could be the final trigger pushing the economy into a full-blown recession. The role of consumer sentiment. A key lesson from history is the power of psychology in economic outcomes. The 2008 financial crisis, for instance, was exacerbated by panic and a loss of consumer confidence. When people believe a recession is coming, they tend to cut back on spending, delay major purchases, and hoard cash. This behavior, while rational on an individual level, can collectively contribute to the very downturn they fear. In 2025, surveys show that consumer confidence is shaky at best. Concerns over high living costs, unstable housing markets, and the rising burden of personal debt are causing many to tighten their wallets. If this trend continues, declining demand could cause businesses to slow production, cut jobs, and shrink investment, setting off a domino effect toward recession. Lessons from 2020. Can governments prevent the worst? The COVID-19 pandemic brought the world's economy to its knees in 2020, but aggressive government action helped stave off a prolonged depression. Massive stimulus packages, loan forgiveness programs, and central bank interventions kept money flowing and prevented a total collapse. The question in 2025 is whether such interventions are still feasible or politically palatable. With many countries already carrying record levels of national debt, another massive round of stimulus may be out of reach. At the same time, public support for government bailouts, especially of large corporations or banks, has waned. Still, history suggests that smart targeted policy responses can help blunt the worst effects of a downturn. Investments in infrastructure, education, and renewable energy, for example, could create jobs and stimulate growth even during tough times. Final thoughts: recession or reset? So, will 2025 see the next big recession? The answer is maybe. The warning signs are there: high interest rates, inflated asset bubbles, global instability, and shaky consumer confidence. But history also shows that downturns can be opportunities for transformation. Each recession has reshaped the economy in profound ways. The 1930s gave birth to the modern welfare state. The 1980s transformed monetary policy. The 2008 crisis led to the rise of fintech and new regulations. If a recession comes in 2025, it might spark innovation in AI, green energy, or new forms of work. Rather than fearing the future, we can prepare by learning from the past. Staying informed, managing debt, diversifying investments, and supporting adaptive policies are key ways to weather whatever lies ahead. Let me know in the comments section below. What do you think of our video? If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.